Welcome to HPK Provident Advisors Friday Live. This is where one, two, maybe three of the partners of HPK Provident Advisors jump onto Facebook, 12:30 p.m. Eastern Standard Time each Friday. This is Friday, August 8th, 2025. Life's going by quickly, certainly getting deeper into the second half of the year. Today, we have two of the partners at HPK Provident Advisors. Of course, we have offices in Pittsburgh, Pennsylvania, and Sarasota, Florida. Myself, Brian Peluso, and Mike Kutch. Mike Kutch is our portfolio manager. Spends a lot of his time working on the individual allocations, the investment selections, and things along those lines. Mike, let's jump right into it. Of course, what we do here on each Friday, again, 12:30 p.m. Eastern Standard Time, we review some of the social media posts that we put out during the week. So we put out a lot of content, and each Monday, Mike puts out kind of the preview of the week ahead. And then we have some financial planning topics, some life topics. So what we're going to do today and what we do each Friday is talk a little bit about those posts. Mike, let's start out with what was going on with the week ahead, what you thought you were going to see, what we did see, and any other thoughts, commentary on what's been happening in the markets.
Yeah. So every Monday we do the week ahead post, which is kind of a recap of what happened in the previous week and what I'm looking for in the week ahead. So to end last week, we had that non-farm payrolls that had a miss to the downside, came in at 74,000. And the big thing with that was the revisions to the prior 2 months. So instead of the range, the 3-month average being about 150,000, we are now around the 35,000 range. So that was a big shock to the perception of how we viewed the labor market. So we had that gap down on Friday and saw follow through on Monday, meaning more downside. Now, after that, we had a rebound. We got back to that gap level on Thursday, but it looked like it was a failed attempt. We are making another attempt today, so we'll see if we can get through that level. Given where valuations are, how big of the run we've had from the April lows, I think it would be healthy to see more downside, and I think that could be warranted. The levels I'm looking at are, let me pull up the chart real quick, and then I'll get back to the blog post. So I think potentially we could get down to the 200-day moving average, which is around 5,900 on the S&P 500. We do have some different support levels along the way. I think area we could find some support is around the February highs, which is around the level of the 50-day moving average. Let me just highlight what bond yields have done, because I think that's an important factor. The markets are pricing in almost a certainty. I think it's a 90% chance of a September cut. August is not a live meeting. It's the Jackson Hole Symposium, which has been a shock to the market in the past, but it's really about the September meeting. So more and more Fed members are coming out saying, yeah, maybe it's time to get back to the rate cuts. So you can see that reflected in the 2-year here, big downward moves. We did come back a little bit on some of the economic data this week, even though I saw it a little more mixed. The 10-year is what I really want to highlight. You saw this big downward move on Friday, and we broke down. This is a formation in technical analysis called an ascending triangle. So it was a definitive breakdown. So I would guess we might have a little more rebound here, but I think the overall trend here is to the downside. So we'll be keeping an eye on mainly not only the bond markets, but of course the stock markets. Like I said, we are trying to fill that gap again today. We really need to get above the levels we reached intraday yesterday and close that gap on a daily basis. But my base case is to the downside. So we'll see if that happens or not. Economic data this week was a little light. We had ISM services that came below expectation in the prior month. It's flirting with that contractionary level. So that has really been an area of strength over the last couple of years, where manufacturing has been the weak point. But now we're starting to see that catch down. Unit labor cost was also higher than expected. So that could feed into inflation, not necessarily a good thing. The one thing that is positive is productivity growth for the quarter came in better than expected. So that could create a dynamic potentially where you could have growth increase and inflation going down at the same time. So that was a nice rebound from the prior quarter. So hopefully that trend continues. But really, we've been watching earnings. We're about 2/3 of the way through the S&P 500 companies reporting, and it was a low bar. Estimates were for about 5% for the quarter. We're sitting around 10.2%, so pretty healthy. 82% of companies have beaten. That compares to the 5-year average of around 77%. So good on that front. Next week, we will be looking at some important data. We'll get to that later in the program. But that's pretty much what the summary of the Monday look ahead post was.
It sounds somewhat similar to the last few Fridays that we talked about. It's a little bit mixed right now.
Yep.
You got a sense on this? What's your feeling on this? We go down before we go up?
I think we do. Yeah. We've just had such a strong run off the April lows. And the reactions I've seen from earnings reports, the beats aren't really getting rewarded that much. And if you do miss, the companies are getting punished on the downside. So I'm seeing some weakness in price action. Earlier in the week, I was scratching my head. I'm like, why is the market up today? It was up a decent amount, but underneath the surface, it was pretty much held up by Apple. I think the equal weight actually saw a decline on the day. But as you know, the major S&P 500 is market cap weighted. So it's really driven by those big mega cap companies. One other indicator or one other economic metric that I flagged last week that I wanted to look at was consumer credit. Credit card and loan amounts are going up. So that's something to keep an eye on. We'll be keeping an eye on the default data. I mentioned last week we were starting to see that increase in the higher income threshold. So a little bit of an alarming signal. So something to keep an eye on.
Well, mixed data. What we do know is that historically speaking, any sort of downturn that you get in the market for folks that have a long-term perspective for their long-term buckets of money, which, by the way, long-term is relative to each individual. Long-term could be 50 years. Long-term could be 10 years. But for your longer-term buckets of money, when the market goes down, history has proven for those portions of your financial plan, it definitely has been when market goes down, a pretty good time to think about allocating some idle monies. And we know a lot of folks that have been capturing some of the interest rates that are decent in money markets and CDs. Those are coming down a little bit. So if we get some sort of downturn, might be a buying opportunity if you have the appropriate time frame and you're using the right bucket of money through your financial plan. It could be something to look at. Obviously, when we talk about the market going down, it's dreadful. Most people say, oh, this is absolutely terrible. I knew it was coming, right? Everybody knew something was coming when the market goes down, if it does. But that could be a great time to deploy some idle capital. So keep that in mind. This, and we had talked about this in a prior Friday, is dealing with things as they come, having a good plan that is able to weather a lot of different conditions, being comfortable that your longer term goals are still on the right track. And so whatever comes up, higher interest rates, lower interest rates, higher housing prices, lower housing prices, tax law changes, you're ready to sit back and say, hey, it is what it is. Just need to adjust and adapt. And that's kind of what we do through our financial planning. And that's what Mike is alluding to in the portfolios as well. Mike, I throw a little curveball at you. Through various points in my career, people have said to me, the bond managers, the bond market is really what to pay attention to. The stock market gets all the headlines, but it's really the bond market you got to pay attention to. Do you subscribe to that? Do you lead any credence? Is there any credence to that?
I would say I don't see the bond investors as smarter than equity investors, but I think rates are very important to pay attention to, because if they move too much in a certain direction, there's kind of a threshold in mind for equity investors where, for example, if the 10-year gets to 5% from the current level, that's a panic level. So we're going to sell off equities. So it's certainly something to keep an eye on. It really paints a story of what's going on. The long end is a reflection of what's going on in regards to economic growth and inflation, while the short end is more a reflection of what's going to happen to monetary policy. Are they going to cut rates? Are they going to raise rates? Just kind of gauging where that could be in the future.
Fair enough. Very well said. I didn't mean to imply that the bond guys are smarter. I certainly wouldn't do that. Certainly,
did I come across as offended by that?
Certainly plenty of equity managers that have done great for themselves.
All right, so Brian, how is throwing a party like life itself? Your Tuesday post.
Boy, that was that kind of struck me. By the way, what we're looking at here, this is HPKProvidentAdvisors.com. Here's our website. So if you go onto the website and then you go over here to resources and the blog, this is where you can find all of these things that I'm referencing. Yeah, Mike, so my daughter graduated from high school. She's our youngest. So now I only have adults, don't have children anymore. And so this was the last of our graduation parties. And towards the end of the party, it really hit me how quickly the event itself went. There was so much planning around it, so much time and thought and effort into getting into that. And, it's getting later in the evening, and it just dawned on me, as happens to many of us in very important events, how quickly it went, how much time was put into it, and how it felt like in the blink of an eye, the party was almost over. Then the party's over. We're cleaning up, everybody's gone, and I realized that I didn't have as much time to spend with everybody that I wanted to. People were coming and going. I wanted to make sure that there's plenty of food available and that everybody was enjoying themselves and so on and so forth. And I thought, it's kind of a vignette of life itself. We do so much planning. We do so much thinking about where we want to go and what we want to do. And then we get there and it goes so quickly. And that could be anything from a vacation. Think about how much time you put into a vacation, and you save for it and you make all the arrangements, and then you get there, and on the last day of vacation, I'm like, oh my gosh, where did it all go? Mm-hmm. And those examples are kind of what goes on in our lives. And for me, certainly, I think about where I want to go and what I want to do and these bigger picture things. And then when I get to those major accomplishments and those milestones, they go by so quickly. So the planning is certainly important and critical to get you to where you want to go, whether that be hosting a nice party. I hope everybody thought it was a nice party, having a great vacation, retiring, whatever it is. The planning is absolutely critical. But I was just hoping through my example that people will recognize it's also more important, maybe even the most important, to sit down and reflect and enjoy the moment. I unfortunately have a very difficult time just enjoying the moment, just saying, here's where I'm at and this is wonderful and I'm going to enjoy every little piece of it. I have a difficult time doing that.
Did you enjoy those what are those, cannolis? Did you enjoy those at least?
Well, those are the Lady Lucks.
Okay.
My wife's 100% Italian, and she has always made Italian cookies for Christmas, every Christmas in particular, but for these bigger events as well. That's one of her signature items, is the Lady Luck. So it's a cream-filled pastry, and I would say it is the most requested of the, I don't know, maybe 30 or 40 different kind of cookies that you made for the party. But it is the one that is most requested, most enjoyed. And so that's why I wanted to put that picture.
Well, they look delicious.
I did. I enjoyed probably too many. I think most of them are gone by now. We did freeze some after the party. But planning is important. But enjoying the moment when you get there, whatever that moment is just as important. So that's why it's like a party. Life is like a party in the sense that it requires a lot of planning and it goes by so quickly. So enjoy the moment, enjoy your family and friends, kind of like the party. I don't feel like I get to spend as much time with my friends and my family and loved ones as I would like to. And so through that example, I'm hoping that like I felt that I didn't have as much time for everybody, that I make that time, and we enjoy those moments together. So, not to be unnecessarily deep about it, but that's why I think life is like a party. So, Mike, to you,
metaphor.
Does monetary policy work? I hope it works, because we don't have many alternatives.
Yeah, this might have been a controversial post, but the basic premise was, the Fed had a historical rate hiking cycle over the last couple years, and we're kind of on a pause level right now, and nothing's really broken. So I was just addressing the question, does monetary policy still work the way it does in the past? Now, there's certain factors that go into it. It's a blunt tool. They only control the short end, not necessarily the long end. So the long end has a lot more to do with lending in the open market. So they don't have the direct relationship. Historically, yeah, when they cut rates, the long ends come down. But is that going to be the case in this environment? It should to some extent, but the government debt's so high, so maybe not. But I would say, the U.S. economy is so service-driven now that they don't really have direct control over that. Monetary policy does have an impact on sectors, and we've seen rolling recessions in areas over the past couple years. Manufacturing's had a very weak environment. We've been in contractionary territory for most of the last 2 years. Housing has certainly felt the impact. The lower income thresholds are certainly feeling the impact of higher rates and inflation. So it does weaken a lot of areas of the market, but the ones that drive the stock market, like I mentioned before, the S&P 500 is market cap weighted. Those big tech companies, they don't really need financing. So the stock market was able to do very well. I mean, obviously 2022 was a brutal year for both stocks and bonds, but since then, I mean, rates are still high and companies are doing well. Now, I should mention, in March of 2023, we had 4 of the 5 biggest bank failures of all time. So perhaps
lots of fun.
Perhaps if the Fed didn't step in and say, don't worry about it, like, we'll be there for you guys, maybe that would have created a broad economic recession at that point. So maybe it still does have that same impact, but I was just bringing up the question because I find it interesting.
I'm sure many people did find that interesting, on the good side or the bad side. Well, there's not many alternatives, and we're going to have plenty of Fed policy, and we're going to see a whole bunch more of it, whether we like it or not. But it goes back to the idea of have a good plan, have a great foundation, and make adjustments along the way. There's not a whole lot that we can do. We can observe. There's not a whole lot we can influence about what the Fed's going to do. Raise interest rate, not raise interest rates. In Mike's example, save banks, not save banks. We don't have a ton of influence over that, or any influence, quite honestly. But what we can do is understand what their decisions are, understand how it affects markets, economies, and then how it affects you, and make those adjustments. It is what it is.
And then fiscal policy might be doing something completely different, being a headwind against monetary policy or further fueling whatever agenda they're trying to do. And we had a great experiment during COVID where, it turns out if you send money to people, they're going to spend it, and companies are then going to raise prices. Who would have thought?
More spending, more raising of prices. I don't think the COVID prices have come down. I understood the supply and demand dynamics there, right? Less supply, couldn't get ships. We were talking about that last week. There were ships out in the ports. We couldn't get the things we want. A lot of people had extra money from the government stimulus, but there wasn't enough stuff on the shelves to buy. The prices went up. Fair enough. I don't think those prices came down.
And that's the thing about inflation. When we're talking about inflation's coming down, what we're really talking about is the rate of price increase coming down. So the goal is to have it under 2% or around that 2% level. It's rare that prices will actually come down unless you do enter a true recessionary environment.
Well, then,
so we gotta pay more for goods.
Prices going up. Maybe not so bad. It's not great. It's not what we want, but hey, is what it is.
The key is if wages are going up at a faster rate. than the price of goods.
Oh, fair enough. Fair enough.
So
Well, we'll
Social
keep an eye on
Security,
that for.
teach me
We'll keep an
something,
eye on
Brian.
that for. You know, a lot of people ask me about Social Security questions. It's one of the things that I've studied for many, many years. I've taught investors, I've taught advisors about how the program works. And it's super important to get it right. In the sense that a lot of the decisions you make about when to collect Social Security, if you start collecting, are irreversible. There's some ways that maybe they're not, and some adjustments. But the best way to look at Social Security is once you make a decision, it's an irreversible decision. So it's important to get it right. If you live a nice, long, healthy life and you're collecting Social Security, it's quite possible that what you will collect over your lifetime will be one of the biggest pots of money that you have. Of course, they don't just hand you a lump sum and say, here's all your money, spend it judiciously over time. But if you go out towards the end of your life, 30, 40, 50 years, whatever that is for your age, and look back, Social Security will be very important to you. So we've really got to get these decisions correct. Now, some of the posts that we do, a good bit of the posts that we do, are a reflection of cases that we have worked on, and this is one of those posts. And here's how this works. Of course, not everybody wants to retire on December 31st and start collecting Social Security exactly on January 1st of the following year. You absolutely may wish to retire in the summer. And if you do that, and you are prior to full retirement age and collect Social Security, the way things work, if you're a little light failure there.
Watch out, Brian. Be careful over there.
Yeah, I'll tell you what. I gotta get the key grip guys and the lighting folks to work on this. This is only if you're collecting Social Security prior to your own full retirement age. So recognize that all that I'm talking about, for most folks, your full retirement age right now is the age of 67. But if you want to collect Social Security early and you are retiring from your job in the middle of the year, there's a special rule that you need to be aware of. So let me paint this scenario. Let's say you're 64 years old. You've made $50,000 from January through June, and you want to start collecting Social Security. You want to retire from that job. You want to start collecting Social Security July 1st of that year. Well, you've already made $50,000. And the way Social Security works is if you're collecting prior to your own full retirement age in the year 2025, if you make more than $23,400 while collecting Social Security early, they're going to start pulling some checks back. Well, if you made $50,000 from January through June and you start collecting in July, obviously you're already, for the year, you've earned more than the earnings limit of $23,400. So what do? Start collecting Social Security. You've retired from your career, but you already made $50,000. The special earnings limit rule in Social Security says this, and it's only for the first year that you collect. In the first year that you're collecting Social Security prior to your own full retirement age, they will look at your monthly earnings moving forward as opposed to your earnings going back to the beginning of the year. This is only in the first year that you collect. So in my example, you made $50,000 from January through June, start collecting Social Security in July, and you've retired from your other job. They will try to determine if you will make more than $23,400 in 2025, but they'll look at it on a monthly basis, which is $1,950. So you start collecting in July, you retired from your career job, you had already made $50,000 for the year, you're collecting Social Security starting in July. What they're going to do is they're going to look to see if you've made more than $1,950 in each of the months for the remaining part of the year. That will be your earnings limit just in the first year that you collect. Moving forward, so you get into January of the following year, you're retired, you've collected Social Security from July through December. Starting in January 1st of the next year, you're back on the annual amount. So they will determine what your earnings are on an annualized basis. And if you're over that limit, which again is 23,400 in 2025, then they can start pulling checks back. So for those folks that want to collect Social Security prior to full retirement age and you're retiring in the middle of the year, but you've already made more than what the earnings limit is, give us a call. We can walk you through that. We can walk you through what you might receive from Social Security that will seem a little bit alarming, what you'll need to provide to them to prove to them that once you started to prove to them being Social Security, that once you started to collect benefits, that you were not making over $1,950, and therefore there should not be a reduction in your benefits.
So Brian, quick
yes.
question.
Yes.
So say we run that scenario, I retire in June, I start taking Social Security, and then February comes around the next year and I'm like, I'm bored. I'm going to start working again. I'm going to make $100,000 a year. What happens? Can I pause my Social Security? Does it get reduced? Does it get taxed?
Oh, all right, Mike, we might have to cover this. And there's a lot there. And we've seen this before. We've seen people that have say, hey, I want to retire early. It's going to be great. I'm going to ride my RV around the country. I'm going to golf a lot, whatever I'm going to do a lot of gardening and things along those lines. 2 years into it, they say, I'm bored out of my mind. I'm going back to work. So in that case, Mike, if you go back to work in February and you make $100,000, well, you're on that new because you're beyond the first calendar year that you've collected. Now you're into February of the following year. You're collecting your Social Security. It's prior to full retirement age, remember. And then February you go back to work, and then you make $100,000 for that year. Clearly, you're over the $23,400 limit. So they will request money back, a lot of money back in that case, because every dollar that you make over $23,400, that's the 2025 limit. Every dollar that you make over that, every $2 you make over that, they're going to reduce $1 of your Social Security. So, Mike, in your case, you collect Social Security from July through December. Then in February, you start making money. Social Security is going to come to you and say, now this will be at the end of the following year when you do your taxes, and say, we paid you too much. You were way over $23,400, so you owe us a bunch of money back. That's what's going to happen there.
And that's your calendar year. So like next year, the following year, I decide not to work again. It won't be permanently reduced, correct?
That's right. They do it every calendar year. Once you do your taxes in April of any given year, the IRS sends all that data over to Social Security and says, this is what Mike made, and you do your reduction Social Security as you see fit. But in that case, Mike, if somebody came to me, they started collecting Social Security in July, and then the following February, they said, I'm going back to work. I would actually have them pull their application, because you can change your Social Security decision within the first 12 months of that decision one time in your life. So you have a one-time redo that must be done within 12 months of your decision. So, Mike, in that example, somebody starts collecting in July, they come to us in February and say, you know what, I'm going to go back to work, but I'm going to be way over that annual earnings limit. Now all my Social Security is I took a reduced benefit because I'm prior to full retirement age. All that Social Security is going to have to be paid back because I'm making a bunch of money. In that case, what I would say is you're within the 12-month window. You get a complete redo within 12 months of that decision. That redo is only once in your life, though. So you can't just say, I'm going to collect Social Security for 8 months and then pull it back because I'm within the 12-month window. And then 2 years from now, I'm going to collect again, and so on and so forth. So, Mike, the answer to that is several different parts. One, if in February of the following year you start making a whole bunch of money, yes, you are on the 23,400 annual clock, if you will, annual limit. But specific to that situation, because you had not been collecting benefits for more than 12 months, my suggestion would be, if you plan to work for many years and make $100,000 a year, I would reverse my Social Security decision because I'm within that 12-month window. But again, you only get to do that once in your life.
Okay.
See, Mike, it seemed like a simple question.
Well, now once we get you talking about Social Security, it's
a secret. Hey, I'm going to wrap it up for Mike. What do we got for the week ahead? Let's do that.
Yeah, so we'll have the week ahead posts like every week on Monday. The highlights I'll be looking at are the CPI data, which is the inflation data, coming out on Tuesday. Headlines expected to come in on a monthly basis a little bit lower than the previous month, but it is going to tick higher on an annualized basis to 2.8%, while core is expected to come in higher than last month on both the monthly and year-over-year basis. So we're going to be expecting a 3% year-over-year rate on the core CPI measure. Thursday, we'll get PPI data, which is the wholesale inflation data, as well as retail sales. So obviously, retail sales is an important one to watch to gauge the overall health of the consumer, whether people are still spending or not. And then let's see, post-wise, I believe we have something coming about what's the term I'm looking for in regards to property taxes, like
if your assessment.
The
assessment, yeah.
And then Wednesday, I have a post coming out talking about, we're getting to the point where the Fed's probably going to cut interest rates. So if that happens, there's been the view of, when the Fed cuts interest rates, then I'm going to buy a house because rates are going to come down. Of course. Not necessarily the case. Like I mentioned before, the Fed only controls the short end of the yield curve, the Fed funds rate. So mortgages are more tied to the long end. So is that necessarily going to come down as well? Maybe, but like I mentioned, government debt's really high. Inflation's still lingering its ugly head. So maybe the long end stays higher for longer. Now, I have a theory that if rates at the long end do come down, maybe that floods the markets with inventory for people that have been waiting to sell until rates come down because they don't want to give up their low rate mortgages. Another factor that we have to look at is home builders have over a 9-month supply of inventory right now. That's rarefied air. That's not a good thing. So maybe we get flooded with inventory and home prices actually come down in value.
Yeah, along those lines, Mike, I'm starting to see advertisements from certain lenders that say, hey, it's a good chance maybe your home equity line of credit rate goes down, but the mortgage rate doesn't go down, which is kind of a reflection of the Fed being able to affect shorter term rates and not longer term rates. I'm starting to see that people saying, well, consider home equity loans as opposed to, getting a mortgage, or if you're getting a second property or something along those lines. Okay, that remains to be seen. But we'll address that. We'll address that in their post. We're going to address that on Friday Live, 12:30 p.m. Eastern Standard Time each Friday. We have a special series that will be coming out for the next several Thursdays, and that series is on OB3. That's my term, Mike. It's
I like it.
The one big, beautiful bill. A lot of people will call it the OBBB. I'm going to call it OB3. So each Thursday, for the next several Thursdays, we're going to cover little pieces because there was a lot there signed on July 4th of 2025. There are a lot of things in the OB3 that are going to affect everybody. Each piece of it is not going to affect everybody completely, but there are pieces of it that will affect you in some way. We're going to break those down into individual components over the next several Thursdays, and we'll talk a little bit about those on Friday as well. Mike, I'm going to wrap this up. This has been great. You got me wound up on Social Security, so we ran a little bit long. This is very important. This is the disclosure statement that we want you to understand and certainly appreciate that the securities through us are offered through LPL Financial LLC, which is a member of FINRA and SIPC. Advisory services offered through LPL Financial LLC, a registered investment advisor. Brian, Mike, we are registered representatives of LPL Financial LLC. The content discussed is for informational purposes only and not intended as an offer, a solicitation, or an encouragement to buy or sell any security or utilize any investment strategy. Our opinions that we have talked about are those of the author and authors, me and Mike, and not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the potential for loss of principal. The communication may include links, which you saw links to our website. Mike had the charts up there to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites, although we really like to scrub and make sure that we're looking at places that are pretty accurate. Brian and Mike and HPK Provident Advisors may only transact business in states where we are properly registered or exempt from state registrations. Please contact us directly for information regarding licensing and registration status. Most importantly, past performance is not indicative of future results. Always consult with your financial advisor, tax professional, or attorney regarding your specific situation before making any financial decisions. That whole thing makes me relatively lightheaded to get through, but it's very important. All right, let's wrap it up. Mike, you have a great weekend. We'll catch up with everybody. Check for our posts on social media, and then we'll be back next Friday, August 15th, 12:30 Eastern Standard Time.